Welcome, everybody, to the Investor's Guide to Thriving. Well, it seems every week that goes by in 2020, it only gets stranger. This week, I learned two things. First, I read on Twitter that getting COVID can actually be a blessing, but it was a tweet from Donald Trump, so it came with a warning that it could be fake news. Secondly, after the US stimulus plan was put on hold, the market promptly plummeted, but then the very next day it went back up, even though literally nothing had changed, because the noise from the markets made it more likely there would actually be more stimulus. So basically, at this time, the market, as far as I can tell, and my 4-year-old operate on exactly the same fundamentals. Well, you can count on my longtime business partner, Larry Berman, to always have a take on what's moving markets. And fortunately, every Thursday at 7 p.m. Eastern through December 3rd, you can tune into this weekly webinar series to find out what he's seeing in the tape. But the market isn't the only thing that needs financial support these days. One of the core goals of Investor's Guide to Thriving is philanthropy. And in particular, Larry and I are big supporters of Sick Kids and the Baycrest Foundations. We ask nothing in return for putting on these events, virtual or hopefully one day in person again. But we do ask, and we do hope that you can join Larry and I in supporting childhood leukemia research at Sick Kids, who we also appreciate your support for the groundbreaking work being done at the Baycrest Foundation into the treatment of Alzheimer's and dementia. For those of you who have made donations, we thank you very much. We match all of your donations. If you would like to make a donation, please use the links in the survey that you'll receive after the event. That survey is also your gateway to access the webinar replay. It'll arrive in your email tomorrow morning, and all you have to do is tell us how we did, and you'll get a link to access all of the above and submit questions for next week's webinar. Well, we're thrilled to be able to bring you Investor's Guide to Thriving in large part due to the support of our excellent partners. And that includes National Bank Direct Brokerage, who not only support this series, but also Larry's Investor 101 videos that you can find on YouTube. If you like those, be sure to hit the subscribe button, and there's a little bell thing next to it. If you click that, then your phone will tell you the second that we post something new on YouTube. I think we've got over 5,000 subscribers now, so that's pretty cool. Here tonight we have an overview of National Bank Direct Brokerage's state-of-the-art investor platform. We also have a promotion that they've been good enough to offer for our audience where you can get 200 free trades. To tell you more about that is Ann Lee from National Bank Direct Brokerage.
Thank you, Jared, for the introduction. So my name is Anne, and I am one of the business development managers at National Bank Direct Brokerage. And for over 30 years, our aim is to encourage clients to play an active role in managing their finances through self-directed investing. We are very happy to be here again this season in support of Baycrest and Sick Kids, and of course, all the work that Larry has done for these foundations. As for tonight's topic, I will be highlighting some ETF-specific tools and research that we have available on our trading platform. Now, before I start with the fun stuff, I of course have to start with a disclaimer. And to quickly recap this slide, I'm here to remind you all not to take anything that I say as actual advice or recommendations. National Bank Direct Brokerage is ultimately self-directed, which means it is important to do your own research and due diligence before making your own investment decisions. So the first thing you'll see upon logging in is your summary page, where you can see a quick snapshot of your total accounts and assets and their performance as of the last trading day. You'll notice that simplicity and ease of use is one of our main focuses of our user-friendly platform, in that you'll have your most commonly used buttons on the top right-hand side. So things like your buy and sell buttons, transferring funds in and out, the quote lookup, and other various portals to your accounts in detail. Moving on. This is where you'll get an overview on the current markets, whether it's the various indices, currencies, top movers, and more. Because the focus today is on our ETF-specific resources, let me introduce you first to what's called our ETF screener. So you'll find that by clicking on Markets, Overview, and then the ETF screener, and you'll be brought to this page here. So the easiest way I like to explain the filtering tool or screener is that it's comparable to a dating app. So just like how you hopefully know the characteristics that you're looking for in your perfect partner, you can also find your perfect ETF, or a few of them, I don't judge, simply by entering in the characteristics or filters in this case to find your match. So for example, let's say you're looking for Canadian ETFs that are passive, that are focused on equity and specifically financial services equity. The more filters you add, the more tailored your results will be. And once you enter in your selections, you'll notice that there are 11 ETFs matching your results. And on to the next slide, we'll show you what those results are. Moving on, this is your 11 results, and they are sorted by their market cap. Since we really didn't specify much as to what exactly we were looking for within financial services equity, you'll notice that there are quite a few interesting results, like a couple of ETFs from our friends at BMO, such as ZWB, which is an ETF of Canadian banks that earn premiums from writing call options, which might be an interesting alternative to implementing the covered call strategy yourself. Or maybe ZEB, which is an ETF consisting of the Canadian banks, except it's not based on their market cap, but actually it's equally weighted. So there's no favoritism whatsoever. Moving on. Our platform also provides various research reports on ETFs, and you'll have access to the reports from our own in-house research team at National Bank Financial for free. You can find all of that under the Research tab, under Publications, and if you scroll a little bit further down, you'll reach the NBF Research section. Now, today specifically, I want to highlight the document titled Exchange Traded Funds, Canada and US. And if you can see on the next slide, it will show you this document in particular, which is an interactive PDF. So wherever you click on it, it will redirect you to the specific list of ETFs based on the type of sector, or you can also find Canadian and US ETFs, whether they're large and mid caps, global markets like China and other countries, more niche markets like electric driving vehicles, blockchain, and many more. In our case, let's look at ESG focused ETFs. And by actually clicking on it, it'll redirect you to the specific ETFs. And in our case in particular, under ESG equity. So you'll have access to important information like the ticker symbol, name of the ETF, MER fee, dividend yield if it pays one, as well as its tailored focus. Overall, I find that this report is great if you're looking for ideas or maybe a more broader starting point. Now, speaking of ETFs, on our next slide, I can show you how you can do your ETF trading at National Bank for free. So we don't charge any commissions for buying and selling all Canadian and US ETFs. So any of those ETFs that you saw on the list prior, zero commissions. Whether you're buying Vanguard, BMO, or Horizon ETFs, that's also zero commissions. To take advantage of that, make sure that each time you buy or sell the ETF, that it is 100 shares or more. Make sure to also do the trade online. And finally, on the topic of ESG, be eco-friendly and make sure all of your documents are set to electronic delivery. And that's pretty much all you need to do to not pay commissions on ETF trading. Now, on the next slide, if you haven't heard of National Bank until today, then you probably haven't heard about our low commissions. And we have something for everyone. So if you are a National Bank client, you can trade for $6.95. Maybe you're under 30 years old, then you can trade for free, and then $4.95 afterwards if you go over the 10 free trades. Maybe you're also an active investor, and you're doing more than 100 trades a quarter, then you can benefit from 95 cents a trade. And yes, that's not a typo. On to the next slide. Because we are excited to be part of Larry's tour this season again, we have also included an extra perk to those that have taken the time to join us this fall, especially during these rather interesting circumstances this year. So for new clients of National Bank Direct Brokerage that open an account from now until the end of the year, you will get 200 free trades to use for up to 1 year. So the conditions are rather simple. You should be a new client to us, enter the promo code during the account opening. Keep in mind that these are for trades that are done online. And finally, make sure all of your documents are set to e-delivery, and that's it. We have a few options as to how to open up an account. You can visit your nearest national bank branch. You can also contact our call center to access our account opening team, or you can also do it yourself online through our main website. Last but not least, we also have some short, useful videos on our YouTube channel in case you wanted to view more about our trading platform. To conclude, if you have any other questions about our offering, my colleagues at the call center will be more than happy to assist you, or you can also reach out to us directly by email. Thank you again for your time, and now on to our next speaker of the night.
Thanks very much, Anne. We're very grateful for the partnership we've had with BMO ETFs ever since 2009. They're the original and premier sponsor of the Investor's Guide to Thriving. And for those of you who didn't know, Larry and BMO teamed up in 2013 to help you navigate turbulent markets through our co-managed ETFs and funds of ETFs. They're actually managed by Larry himself in ETF Capital Management. They're available to you through your online brokerage or investment advisor. BMO continues to lead the Canadian ETF industry, offering an ever-increasing array of ETF tools to help you grow your portfolio. Here to show you a few examples is Laura Tasse from BMO ETFs. Laura, I'll turn it over to you.
Thanks, Jared, and good evening, everyone. Thank you very much for having me, and thank you, Larry and Jared, for being such great partners to BMO ETFs. As Jared mentioned, my name is Laura Tasse, and I'm an ETF specialist with BMO ETFs. And tonight, I'd like to walk you through a couple of tips that we found very useful when trading ETFs. Before we get started, though, just a couple of minutes just to introduce my firm, BMO Global Asset Management and BMO ETFs. Where for those of you that are not familiar with us, BMO is one of the top 50 global asset managers. We have over 300 billion in assets under management. In Canada, BMO ETFs has been #1 in net new assets for 9 years in a row. We have about a 30% market share of the Canadian market, and we're the #1 provider for fixed income and smart beta in Canada. And also, as I'm sure most of you have heard a lot about ESG and responsible investing lately, I also wanted to highlight a couple of things here. BMO has been one of the original signatories to the United Nations Principles for Responsible Investing. This organization was created in 2006, and we signed on in 2006. This is a voluntary process, but you'll see that more and more firms in Canada and globally are becoming signatories. So we've been there since 2006. What's also very important is that we are rated as an A+ on our active ownership, on strategy, and on performance. And what active ownership means is that every institutional investor, so any asset management firm, will invest in a lot of stocks. So the more you own of a company's stock, the more influence you have on that. What active ownership means is you're using your votes to steer those companies that you invest in the right direction. So we are rated A+, and we not only do this with our own $300 billion in assets under management globally, but also on behalf of other institutional investors, which is another $200 billion. So with that, let's look at a couple of trading tips that we found very useful. So number one, avoid trading in the open and close of the market. And that's because the ETF price is a reflection of the underlying portfolio value. We always recommend to not trade in the first 10 minutes and the last 10 minutes of the day, because this will minimize volatility, because the portfolio will be most volatile at the beginning, at the end of the trading day. Number two, always use limit orders. The entry and exit price of an ETF will impact the overall trade profitability. Because the underlying market continues to move while you're placing your trade, a limit order can ensure that you get the price you want. Also, keep in mind that if the market moves away from a limit, your order may not get filled. So you always want to check or revisit your limit price and maybe adjust it accordingly. The third tip, trade when the underlying market is open. So market makers are better able to keep spreads tight when the underlying portfolio is trading so that the ETF price can be calculated. When the market is closed, what market makers do is they will tend to estimate the price of the ETF, so they will always set a slightly wider spread to reflect that increased risk on the trade. So to give you an example, when you want to trade a European ETF, you always want to keep in mind the time difference between the North American markets and the European market. So let's say if the stocks in that ETF trade in London, England, there's a 5-hour time difference. So ideally, you want to trade it around 10 a.m. while our market is open and the European market is open. So always keep that in mind, because you're always going to get better liquidity and better pricing when the underlying market is open. Next one, you also want to keep in mind that when the market is volatile, the bid-ask spreads can widen and change quickly. So it's very important to use limit orders, as we mentioned before, because that's the only way to ensure you get the best price. So now let's look a little bit at ETF liquidity. We're getting a lot of questions on ETF liquidity, and sometimes there's a lot of misconceptions and there's a lot of comparisons between stocks and ETFs and whether or not they're the same. So important to keep in mind is that there's two levels of ETF liquidity. There's the primary liquidity, which happens at the exchange level. So this is where buyers and sellers meet and buy and sell ETFs. So that's on your TSX or on the New York Stock Exchange. But what makes ETF so liquid is that secondary liquidity, which or the second level, which is the unit creation based on the underlying securities. And this second level is provided by a market maker. A market maker is an investment professional. So think brokerage firms or capital markets groups at the main banks or any large brokerage firms. And these investment professionals constantly check the demand and supply of an ETF to create or redeem units. So if the demand is higher, they will buy more stocks from that portfolio to create more units of the ETF. Or if the supply is higher, they will sell stock to redeem units of that ETF, so that the basket and the ETF are always in balance. So that's how ETFs tend to actually provide a lot more liquidity than you would with just an individual stock or a fixed income, because they have these two levels of liquidity. The first level at the stock exchange level, where you just buy and sell units of the ETF. And the second level provided by the market makers. If there's not enough ETF units in the market makers will buy the stocks in that basket, create the units, and have them trade in the market. So now if we can move on to the next slide, what we wanted to show here is the importance of staying invested, because as Jared mentioned and Anne mentioned, we are going through some very unusual circumstances and a very difficult time. And when you're seeing a lot of volatility, many investors sometimes, when the market corrects significantly, they just want to get out and then come back in when things settle down. but it's also very important to stay invested. So what we're showing on this slide is the 2008 example. I'm sure everybody here remembers the pain of 2008. So what we showed here, the blue line represents the TSX. So and also what it would have meant if, let's say, you held the TSX and you didn't sell, and you just held it through the pain of 2008, 2009, and so on. The red line shows an investor who would have sold in 2009 because that was the bottom of the market, and typically that's when investors tend to give up and just sell. So you tend to sell at the bottom of the market. Even if they were to come back into the market, let's say a year later, there's no way you could ever catch up to someone who would have stayed invested. So it's really important to see the volatility that happens and the challenging circumstances for what they are now, but know that it will always get better. And the next slide, again, to the same point, staying the course. So just to kind of tie it into the slide before, there's been a lot going on in the past. So if you're thinking that things are bad now and very challenging, yes, they are, but they've been worse in the past. So there's so many examples. If you look in 2007, 2008, the subprime mortgage crisis and credit crunch, 2012 European crisis. Even before that, if you look in 2001, the tech bubble. So there were those, when you were in the middle of those, they felt like the worst crisis that you've been through before, and yet they all passed. Well, I think what's important is to keep in mind that you always want to think about your long-term plan. Any hiccups that come along the way, we're going to get through them just like we did over the last 50, 60 years, and even more so. And I'm sure Larry will talk a lot more about this. But always think about your long-term plan, stay focused on it, and also be prepared for multiple scenarios. Who knows what's going to come out of this? There's many ways that, depending on the elections, how things are going to go. So maybe work with a planner or a tax specialist, or work with a specialist and an expert like Larry Berman. And in closing, just want to highlight an idea for you. If you're looking for insights, we offer a weekly Market Insights webinar where we bring guests regularly to talk about the market and ETFs in the context of portfolio construction. This week, we will be talking about US elections. So if you would like to join us, we'd love to have you there. Simply Google Market Insights Prosper, and you will find the link to register. And I hope that you'll join us there. So with that, I want to thank you very much for your time, and I would like to pass it over to Larry and Jared.
Hi, everybody. So hopefully the video is good and everyone can hear me, and I'll get right into the presentation. We've got a little over an hour, and I plan on leaving a lot of times for questions tonight. So. Laura mentioned the U.S. election. I don't think there's anything more important these days but the U.S. election, and so that's going to be very, very big. I'm going to talk a little bit about the pattern of virus and what we can expect there. That's very big. The Fed reiterated in recent statements that it's all about the path of the virus here in terms of their level of stimulus and so forth. But really a lot of focus on election and markets, tremendous number of dynamics at play here. And ultimately, the market is running off of stimulus. Stimulus is more debt, more debt, which ultimately means good short term, bad long term. And then we'll leave some time for questions. So moving right into the vaccine timeline. So I was on a conference call this week. I've probably attend no less than a dozen conference calls per week these days. And one of them I was on a couple weeks ago highlighted this time frame here. And I heard a statement on a conference call this week, and it basically said no one under 18 is currently being tested for vaccine efficacy. So all the testing they're doing are on adults. And right now, one of the biggest transmission areas are basically the youth, call it university age and under. So, the question you got to ask yourself, because what I want to get into is change in behavior that that COVID is going to perhaps cost longer term for us. The smartest people in this industry are saying widespread vaccine is not going to be available till mid next year. Forget all the rhetoric from the Trump campaign about, by the end of the year, by the election. Herd immunity, so where most people are protected, mid to late next year. But that supposes that everybody is going to take it, and the efficacy is going to be 60-70%. We know historically that those are high bars to reach, and so we're going to have still this wave through the next couple of quarters into the winter months, and it's going to be meaningful. And if Congress can't get together on a stimulus bill now, the economic numbers are going to get worse in the coming months. But and I'll get into the election shortly. But on a call today with my good friends at State Street, I just basically added this chart like a few hours ago because I got off the phone with them not more than a few hours ago, and I thought this was very, very interesting. So the New York Fed weekly economic index, which is measuring momentum of the recovery, is clearly slowing from what it has been in the past few months. And so that's one thing to note. But there's all these kind of alternative ways to measure rates of recovery, and you'll all know about bookings at open table in restaurants. And it's very interesting when you look at this graphic in the bottom left, you see that places like the UK, for example, that a few months back had this policy where they were actually paying people to go out and eat. And today, I think the UK had 18,000 new cases. And if you were to equate that to the population size of the US, that would push it well over 100,000 a day. So this is what's reopening is doing. And by all means, we should never shut down the economy again. Like, I guess we had to do that because the world wasn't ready for this and we didn't know what to do. And the science told us to do that. But practically speaking, it's caused a tremendous amount of long-term damage in the economy. And, for example, today, there's no restriction today for people not to use the subway. And for the most part, businesses are opening and people are going back to work. But you can see the recovery, for example, in New York in New York subways is nowhere near near even coming close to full capacity. But there's a lot of talk recently about this K economy, and the markets have snapped back. President Trump actually, when he tweeted the other day that the deal's off, no more stimulus negotiations, and the market's tanked, his benchmark is the stock market, and apparently shortly after that, when he saw the result of his tweet, he rolled it back and he went to Mitch McConnell and McCarthy, who's the leader of the Congress, of the minority in Congress, and basically said, "Do a deal, do a big deal, pump the stock market." Like it was that kind of intensity, and that came from some aides that were close to the source that I heard today on another conference call I was on. But when you look at the damage and you look at the bottom part of the K, because the top part, the college educated, white collar-ish, working, they've pretty much recovered, not to full capacity pre-COVID, but better than it was, a year ago. But look at the some college, look at the high school, look at the less than high school in terms of the rates of employment. And this is going to become a very big issue to me in the election, and why I think people are going to vote, and they're going to vote to fix inequality. I've said this for a number of years now, that the biggest fundamental problem that the world has, but the US in particular, is the difference between the haves and have-nots. And I think a large part of the vote is realizing that they took a shot on Trump, he didn't deliver, and now they're going to take a shot on modern monetary theory, i.e. spending bags of money. So, 2-week rate of change here in terms of 270 to Win's website. So last week we held this chart up and we said, the gold states, these are the swing states, these are the ones that are tight in the race, and the reddish ones, the darker red, are more Republican confirmed, and the more pinkish ones are leaning that way. And same for the blue. The dark blue is guaranteed, Democratic, and then the less blue, the lighter blue, the more it's leaning that way. So when we look at the 2-week change, what they're suggesting now is that Texas 2 weeks ago, that was leaning Republican, is now toss-up. So it moved into the gold category. Florida, that was toss-up, is now leaning Democratic. Illinois, that was a hard Democratic, is now less hard Democratic. Iowa, that was leading Trump, is now, in the middle. But Arizona, so Arizona and Florida are the two big ones that in the last 2 weeks, the polls have started to put Biden ahead by a significant margin. And the reason those are important is the Electoral College math. If on election night, Biden wins Florida and Arizona, it's mathematically impossible for him to lose the election, given what we understand about where the likely votes are going to be. Now, you can do the math. You can fight Pennsylvania, Wisconsin, and Michigan, Mr. Trump, but you're not going to win the election. So it's really about the mathematics of the Electoral College, and nothing more than that. So if you add up Wisconsin at 10, Michigan at 16, Pennsylvania at 20, you get 46. If you subtract 46 from 319, you get 273. So the three big swing states, and where all the battles are occurring today in the courts, meaning they want to throw out ballots and they don't want all these elections. So those three states, the rules are such that all the pre-voting, all the mail-in, nothing can be counted until election day at 7 a.m. So if a state like Michigan, for example, last time around had 1 million mail-ins, and this time around they're expecting 3 million or 4 million. Pennsylvania, a little over 2 million last time. This time could be 6 or 8 million. So they're not going to know on election night in those three states for probably 3 or 4 days. And what they're trying to do in the courts now is to say, if there's no postmark, if this and that, and then throw that ballot out, and all trying to limit, because they know that 75% of the mail-in votes are coming from Democrats. And so that's the big issue. Now, if Florida on election night goes to Trump, different story. We now have a real risk of a contested election that plays out over a number of weeks for sure, but maybe longer. And we'll go to the Constitutional Court, because he's going to fight tooth and nail in Pennsylvania, Michigan, and Wisconsin to get votes thrown out. This is huge. Obviously, if he loses Texas, it's game over for Trump. But Texas probably still goes GOP. So this is the Electoral College math. It's super important, but the markets are now suggesting that because Biden is so far ahead in the polls, they're starting to price in not only a Biden victory, but a sweep, because in the Senate races, they're such now that they're expecting a 68% chance of the Democrats controlling the Senate, which means a sweep. So here Nancy's sitting saying, I could negotiate a deal with Trump now, but I want a minimum of 2.2 trillion or 2.4, wherever number's at. And unless he comes up to me, which he's not going to because the Senate won't let him do that there's not going to be a deal, because she knows with some confidence that post-election, they're going to control all three houses and they're going to pass the whole Green New Deal at 5 trillion-ish. And she's actually gone around to tell a lot of members of Congress that that's what she's playing for. Again, I heard this on a conference call that I was on today. So this is very, very, very interesting stuff. And the market at this point is saying, don't care who wins, we're going to get a massive amount of spending. Now, we're not going to get that if the Senate is controlled by the Republicans, and they're just not going to pass any bigger bills. And that complicates things tremendously, because if that happens, we're going to a constitutional battle. And the timeline on the election looks something like this. So election November 3rd. The safe harbor deadline is when the states have to choose and nominate their electors, and those electors on December 14th vote the Electoral College. And in all cases, in all elections over history, there's only been one or two examples where the person has abstained from voting, meaning the state says you got to pick that candidate, but for whatever personal reasons, they decided not to cast their vote for that. But largely speaking, the states will do that. If Pennsylvania does not have a nominated candidate vetted by the vote, and it's tied up in the court, what then happens is at the legislative level, so the state government, which is in all three states, the state legislature is Republican and the governorship is Democratic. So it goes to the state and they name their own electors, not the ones that the Democrats want, but obviously people who would be pro-Trump. And then they would report to Congress and vote for Trump. And it's very possible when Congress convenes on January 3rd and tallies all the votes that Donald Trump is the president. But if it's caught up in the Supreme Court and there's come January 20th on Inauguration Day and there's no winner, Nancy Pelosi's interim president. So you got crazy number of outcomes here, but the graphic shows that the worst for the markets is when a Republican incumbent loses and is replaced by a Democrat. So that's what we're worried about here market-wise, but the market is so confident at this point that not only are we going to get massive amount of fiscal support, that the Fed's going to be there and that we're going to get a sweep, right? So that's where the market is right now. And the risk is that it's not clear on election night. When the markets were selling off a few weeks ago, it was more, oh, we're going to have a problem on election night and it's going to drag out in courts. And now the market's going the other way. It's pricing in a Democratic sweep. And I'm going to show you some of the stuff on taxes and everything too, because the perception is that the economy won't be that bad off under Biden because he's going to delay any tax hikes. Now, what Kamala Harris said last night is on day one, he's going to roll back the Trump tax cut. So we'll see, because all that matters a lot. But here's the interesting thing. Here's the next chart that again got off a presentation that was done by Ned Davis Research, and they've done some phenomenal work here. And so in the first year of a presidential cycle, what is the best outcome? And that is when an incumbent Republican loses. Why? Because the markets have corrected and continue to correct into the new year, but then they rally back like crazy, okay, because they're kind of so depressed, so there's a big catch up. So I think that is the scenario we're looking at, so that we have some uncertainty after Election Day, some volatility, but tremendous opportunity into buying into whatever pullback develops. And I don't know how far it's going to be. I don't know how it's going to last. But as we get through the election and we do these weekly updates, I'll obviously every week share my thoughts with you on where to position, how to position, and what this is ultimately going to look like. So we trade with Goldman Sachs. They're one of our counterparties. Goldman Sachs, these aren't ETFs, but they're baskets of stocks, and Goldman pioneered the stock basket business. And so what we're showing here is all these little different baskets of stocks that represent, you see Goldman Sachs high tax, Goldman Sachs low tax, Goldman Sachs ACA, so that's Affordable Care Act expansion. So that means, furtherance of Obamacare and so forth. And so all these policy baskets of stocks that are going to perform better or not. So US Democratic policy equity basket, look at that performance, in the last few months. So the market is clearly saying Biden's going to win this thing, and there's not going to be any uncertainty at the moment. And when you look at the versus the Trump basket, and when you look at the high tax versus short low tax pair trade, right? So this would be a trade that would benefit the company. So if Biden rolled back taxes, for example, the ones that benefited the most would underperform, you'd go short those, and the ones that benefit the least, you would go long, and so forth. So all this dashboard is saying the market is pricing not only a Democratic White House, but a Democratic sweep at the moment. And so further, let's look into this. And so what happens when we get a incumbent party that loses post-election? And so if you look at it, you see that technology, when the incumbent party wins, is a drag. When the incumbent party loses, goes up, but very little. So I think the biggest risk to the market right now is in the inflated technology sector in a couple different ways. One, everybody believes that you can do no wrong with technology, but it's grossly expensive and grossly overowned at this point. And in any scenario, incumbent party loses, incumbent party wins. Technology is the biggest risk, where sectors, for example, like financials, look kind of interesting. So, and energy actually stands out too, which is interesting because Biden's just come out and said he wasn't going to ban fracking. Now, of course, it's on his website, Green New Deal, but I think it's more like a no new permits at some point, and kind of phase it out. But naturally, the energy sector is going to phase itself out over the next 20, 25 years. And that's pretty clear when you look at what's going on in the world with ESG and other things. So according to Bank of America, in their last monthly survey, which came out now, it's a little over a week ago, they basically confirmed, it said healthcare, pharma in particular, and technology are grossly overweighted in portfolios. So these are the biggest risks right now. And this is where you take profits. This is where you underweight. You buy dips for sure because long term it'll work, but this is kind of where you underweight. And what's interesting are the banks and the energy sector as two sectors that are really underowned, but in an inflationary reflation trade actually can do very, very well. So looking at the Congressional Budget Office and the Center for fair budgeting, CRFB. I can't remember the acronym right now, but there's the link there on the bottom. What they did was they costed out Biden's plan and Trump's plan, and assuming no other changes, you can see they're both going to spend bags of money, but they're going to spend them very differently. And the biggest single line item is that Biden's going to be raising taxes, both corporate and personal, but not on anyone under 400,000, so the top 1%, basically. And Trump's going to cut taxes, and that the difference there is $6 trillion. Trump's going to spend a lot less on other things, and Biden's going to spend a lot more on other things. So there actually, what people are saying, even though the tax hike from Biden is bad, it's coming from the savers. So the savings rate has gone up and up and up, but it's not the bottom half that's saving money. They're still spending every cent they get, every paycheck. It's the top part, it's the wealth. So they're scraping some of the wealth. Listen, I don't like this. I happen to fall into that top category, and I don't like it at all in terms of policy. However, I get why they're doing it, and it's this inequality issue where the haves and have-nots. So they're going to go after the wealth, and it's a totally different thing. And I think because of the inequality, a lot of marginal voters are going to be motivated to vote that way. So there's a lot of reasons why the elections and people vote for different things, but here's some of the math on this, and ultimately, it means more debt. But when you look at the tax cut winners, could be most hurt here. So if Biden does roll back the taxes, I think he will. The question is when. Does he do it while companies are still hurting and the economy is still hurting, or does he kick it out to 2022 or 2023 and do it then? So I don't know the answer to that, and I don't think he's going to come out and tell us what that is. And if there's going to be no more debates, there's probably going to be not much opportunity to find out before the election. But that's still very, very interesting here. So if you look at the sectors that would be hurt most by the tax rollback, and the ones that benefited the most. So if you look at in 2017, before the tax cut, what the marginal tax rates were: communication services 33.5, after the tax cut 19.5. And so the ones with the bigger spread are going to be hurt the most. Interestingly enough, technology is not a big one. So, depending on which way you look at companies that are going to do better or worse under different regimes, then you come out with different things. But I'm going to summarize it all up for you in a little bit here. But ultimately, what Powell said recently, the recovery will be stronger and move faster if monetary and fiscal policy work side by side, meaning the government borrows and spends and the Fed monetizes it. And that is the reflation trade, ladies and gentlemen. And if that reflation trade continues in a big way for the next couple of years, we're going to correct, but we're not going to correct very much. And the market and the bubble's going to get even bigger and bigger. And you talk about sleeping at night. Like, these things bother me to no end, but that bubble can keep that can keep getting kicked and kicked and kicked. So how you get exposure and how you behave in markets, I think volatility is actually going to stay very, very high, for a couple of years here. I don't think we see normal markets for a long time. Ultimately, that's good for active investors. But when you look at the projection out by the Congressional Budget Office and the Policy Center for Prudent Budgeting, assuming nothing else, and this is not gross debt, this is net debt, but these numbers keep getting worse and worse and worse and projected out and out and out. If you look at this graph, which I showed last week, which was a clip from John Malden's research at Malden Economics, what we did here was we went and looked at the 2019 actual tax revenues on the left. And so the US government takes in approximately 3.463 trillion in tax, of which 1.718 is income tax. So when people file, payroll taxes, deductions from source, and then corporate tax. As you can see, the corporate tax number is tiny relative to the income tax number. So this is an important understanding for people when we talk about corporate tax as well. And then you look at the costs. So the mandatory spending, these are things like promises. So Social Security, Medicare, Medicaid. Discretionary spending is employees. It's stuff we spend money on that we don't have to. So you can lay someone off and not pay them, but you can't not pay their Social Security check. You can't not pay for their Medicare and Medicaid. Okay, so those are mandatory. And then there's cost of interest. You can't default on the debt, so you must pay interest. And if you project those out, according to the Congressional Budget Office, out to 2030, like we saw in that last chart, that interest cost goes up, and that's assuming interest rates don't go up. So the cost of interest is actually gonna not quite double, but close to it, because the debt's going to keep going up and up and up and up and up and up. So these are big, big problems. In fact, the deficit on an annual basis by 2030 is expected to be 1.627 trillion. And the discretionary spending by 2030 is 1.768. So every single dollar, basically, they're taking in tax goes to pay for the interest cost and the mandatory expenses, and they can't pay one federal employee unless they borrow all the money. So this is the path we're heading down. And in fact, Malden in the top corner right side here did a projection based on not the 2% growth rate that the CBO is projecting, but a growth rate that's slower than that. That the amount of debt outstanding by the end of this decade could be 50 trillion. And the right answer is probably somewhere in the middle. So we've got this debt problem, and the Fed's going to just have to monetize it, because that interest cost can't keep elevating. So if you don't think interest rates are going to stay low, that's a big problem. So the Fed wants inflation to go up here. This is a very complex problem, because if inflation rises, interest rates rise. And the only way for them to keep the cost of the debt low is to monetize it. That is wildly bullish for gold and reflationary kind of assets, which ultimately are equities when you think about it. Now, if you look at where we are today, again, this is done by Stephen Leuthold Group out of the States. Do excellent research, these guys. Going back to 1900, a 60-40 portfolio, what is the yield? So the dividend off the market and the yield off, say, the 10-year US Treasury. It's never been lower. In fact, lower by magnitudes. So this is a massive problem for everybody on this call. And what it's forcing us to do is to pay more and more and more in terms of the multiple for equities. And that might, the markets might stay stupid expensive for a long time. Folks, I'm not bullish. I'm not changing my stripes here. I hate what's happening. I think this is awful. I think the people governing us have failed miserably in terms of policy. But this is the path we're heading down. And so when the Fed prints money to reflate, assets, react. And we're seeing that now with the stimulus. So when you get a headline saying no stimulus, markets sell off. And when you get hope for stimulus headlines, markets rally. It's craziness, but it is the world we live in. And because of it, I think volatility stays elevated. Okay. So looking at some of the opportunities. So what works in a reflationary trade? ZMT, this is equal weight global base metals. It's copper, it's aluminum, it's zinc, it's nickel, it's the base metal miners. And the trend here has been awful for the past decade because the world is having trouble growing. But as we move more green, copper in particular stands out. So you make a car today, 35, 40 pounds of copper in that car. If that's an all electric car, it's 3 or 4 times that much, maybe 5 times that much in copper. So that's the reflation. That's the new economy. That's the new world we're heading into. I love this trade, and it's not expensive today. Now, from a short-term perspective off the lows, it is, but from the last couple of year lows, it's actually still cheap. So here's where I'm nibbling. I bought a little bit a few weeks ago in the growth fund. So base metals, and this is the way to play the reflation. This is the way to play the infrastructure spending, more under Biden and Trump, more green under Biden and Trump, better for copper and so forth. And you could go into COPX and play the copper miners directly, or you can get it on a global diversified equal weight basis. Like however you want to play it, I'm okay with this, but it's going to be volatile. Don't make no mistake. Buy dips, buy dips, buy dips. Now, when it gets up to 60 or 70, 2, 3, 4 years down the road, then we reevaluate. But for now, this makes a lot of sense. And it's one of the few sectors and asset classes that I think has some really good potential looking forward. And here's another one. So FLM. So this is the First Trust Global Engineering and Construction ETF. And here's another one that for the past decade has been flat with periods of brilliance. Now, do you remember what Trump wanted to do last election? Infrastructure. Did he do an infrastructure bill? The answer is no. The biggest need is infrastructure. But the traditional infrastructure ETFs, IGF, BMO has got a ZGI, these are utilities and pipelines. That's not what's going to go. It's the engineering companies. If you want individual names, have a look at some of these. You right at the bottom there is Stantec, a Canadian name in this global way to play it. Now, this ETF has been around for a long time. It doesn't have a lot of assets in it. Bid-ask spreads are wide. Laura talked about that. If you want to trade it, be careful. A lot of these stocks are overseas, so most of the time during the day, they can't buy the whole basket. The spreads are going to be wider. But this is a thematic trade that could get back to that 60 level, given where it is now in the low to mid 40s. Again, good upside relative to downside. And this is another one that you can nibble on. Or look at some of those stocks if you want to play the individual stock names. The good thing about an ETF, guys, is it gives you diversification and a broad basket. The bad thing about an ETF is that you end up buying some stocks that maybe don't perform as well as others. So if you're good at your security analysis, then look at some of these names, look at their charts, and maybe you can buy some stocks within that. Increasingly, I think we are in a bifurcated world where some stuff is working and some stuff isn't. And in a lot of cases, you want to look for an ETF that factors stocks and says, hey, these are great companies, they got good balance sheets, but then, not all of them are going to work necessarily. Again, depends on what kind of investor you want to be. So you can use ETFs in lots of different ways, but screening for stocks and quality is a very interesting way. You all know my buy shopping list. I love all these things. Most of them are terribly expensive at the moment in the technology space. So buy dips in them, but don't chase the rallies. Clean energy, it's been a brilliant trade. But these are the names I like, continue to like as ways to play the technology trade. But again, reiterating, it's the most expensive, over-invested trade, and you do want to wait for weakness. Okay, and it'll come. It might be a few months off still, but it'll come, and you'll have those opportunities. Don't chase. And if you're not following me on YouTube, I know there was a question that came in. There was a question that came in about replays, and all the replays. You'll be sent a link. And Steve talked about the survey and the feedback and the charitable donations, or Jared talked about them. And but if you want to see the replays, everything's on our YouTube channel. This is our new portal that we're going to be communicating all our educational content through to Canada and whoever else wants to follow us around the world. But so look at that if you haven't already at Larry Berman Official. I'm going to go to the prepared questions this week, and then I'll get to the ones that have come on online. So Laurent asked, what are my thoughts on TLT? So TLT, if I can try to do this and bring up my Bloomberg chart and see what happens here. So TLT is long treasuries. And basically you're playing the US long bond here. And it has everything to do with the reflation trade. Okay, so this is big, and it's sitting right on the 200-day, and I think there's a risk that we see a spook, we see a technical trade or a break of this level, and that we could see this get into the mid 150s. But ultimately, I think that would be a great buying opportunity for people looking to play the bond market. So short term, a little bit concerned. But Laurent, I would buy a break of that average. I don't buy for a minute that they're going to let long bond yields rise significantly. If the US 10-year gets to 1%, the Fed is going to start talking about yield curve control. I mentioned last week that Fed Governor Lael Brainard is who's a big advocate of yield curve control, is on the top of the list to be Treasury Secretary under Biden administration. And you can bet that she would talk to her central bank buddies about how they best anchor those yields at lower levels. All right, next question, Janie. Heading into next month's turmoil, US election, what sectors? So I talked about some of the sectors that I think can outperform and underperform. I think, you know, if you're talking about putting money somewhere for a month or so, you know, I'm typically not that guy, you know, and as much as I hate saying in cash, I would say this: I love gold. It's one of my favorite asset classes. It's going to be volatile, though. It's not going to be stable. But weakness in gold is going to be a great buying opportunity. Gold equities. So we've had some. The froth has come off a little bit there. But so what sector is going to protect you? You know, there's utilities, consumer staples. Those areas typically are the defensive ones. Sometimes money goes into them when money's coming out of some of the cyclical areas. Doesn't mean they're going to go up. But again, you shouldn't be thinking about trading for, you know, a week or two or three or four kind of thing. You should be thinking tactical, strategic, buy the dip on longer term trends that you would like. And if you're worried about markets, listen, I don't like going to cash, but that sometimes that might be appropriate for some people. I was thinking of taking a position in clean energy, ICLN. It's up over 20% in the last few weeks. Yep. Is it too expensive? So let's have a look at ICLN here. And I'll bring up my Bloomberg chart again. So perspective is always important on these things. So let's do an RSI here. But I'm going to go back and see how far this goes back. I think it goes back quite a bit here. So into 2008. Now, you know, I mentioned this months ago as one of my favorite areas, and you know, look at the size of this base pattern. So do you think we're going to see, you know, a move up here? And that's what you got to weigh this against. So again, buying dips. And where can the dip go? So let's get a little more focused here. We went up, we broke out, we pulled back. It didn't 200-day. You know, if this pulls back anywhere into the trend, you got to buy it. So if you draw a trend line up off the lows, which we could do here, you know, just kind of throw something like that. Anywhere along that trend line, you're a buyer. Now that 200-day might be out of reach until, you know, maybe some point into early next year. You project that 200-day out, you know, up into the middle of next year. It's in the 18 to 20 area perhaps. It really depends what happens. So if we get a correction here, because it is a little short-term overbought, without a doubt, look where that RSI is, buy the pullbacks, okay? Buy the pullbacks. So great question, Mark. Same question on ZGQ. All right, so again, global quality. So this is a factor ETF, which I love. I love the quality factor, great companies, good balance sheets, has been outperforming for a while. Same kind of analysis. Look at that 200-day average, right? Look at when it breaks below that 200-day average. So you know, a lot of people say, oh, you break the 200, you get bearish. No, you break the 200, it's cheap. You always want to buy those pullbacks if you fundamentally believe long-term that something's going to work. You don't know if it's going to hit it and bounce off. You don't know if it's going to spend weeks or months below it. You just don't know those things. You don't know how far it's going to go. You can't know any of that. But what you got to know is buy low, sell high. And right now, a little bit overbought, but you know, pullback, 200-day average, yeah, you got to be there. Thanks for that one, Mark. Kyle asked, opinion to purchase ZZZD right now. So I'm in a little bit of a conflict also, obviously, because I manage ZZZD, and I would say it's one everybody should own all the time and never trade it. My biggest position right now is in the gold sector. And if you look at gold, I'll put up a chart here. Let's do ZZZD here. ZZZD. And what we're going to do is a comparison chart. And we're going to do compare. And we're going to compare ZZZD to ZGD, because that's my biggest holding here. And we're going to add GLD, which is gold bullion. So let's have a look at that on this compare chart and see. So gold bullion, so GLD, that's that line over the last year. Let's look at it year to date for some. So there's ZZZD down here. Here's my biggest two positions. And so ZZZD peaked in July, and it's been consolidating ever since. I've got hedges on it for downside risk and everything else, but my biggest position that was up at one point almost 56, 55% year to date, now is up 31%. So it's all like 20% off the high. So on the portfolio level, yeah, the ZZD came down, but I love this. It's my highest conviction position, and I love it. Now, this is a global yield-seeking fund. The ZZD stands for dividends, but it's a yield-seeking fund, and it's currently yielding a little over 5% on a gross basis, a little over 4% on a net basis. So this is a great strategy for sleep at night people seeking yield and trust that I'm going to be moving things around. So yeah, I think it'd be a good time to buy the pullback. Okay, Kyle. Gerline is asking, why has gold taken such a beating over the last few weeks? So here's another great question. So we'll look at gold again. I'm going to bring up a chart that I follow for gold that I prepared here and that I follow. This is the real US 10-year yield. So it's nominal bond yield, the US 10-year yield, less the inflation rate, the CPI rate, compared to spot gold, and it's inverted. So you can see the correlation to negative real yields and what that means for gold. And if you think inflation, the Fed wants more, so inflation stays high. They are anchoring bonds to lower yields, so yields stay low. So real yields get more negative. This keeps going higher. How high, I don't know, but it is my favorite asset class. So don't worry about the pullbacks. They happen. They get shaken out. We see them all the time. It's related to what bonds are doing and what they're doing relative to inflation rates, but trust that the long-term trend is not over here. Fundamentally, when I believe this is over, I sell everything in the gold sector because at that point it will be fully valued. So thanks for that, Gerline. And Ron asked, these retired pensioners interested in increasing investment exposure to healthcare sector, ideally through a dividend-paying ETF. So I get asked the question a lot on healthcare ETFs and ways to play healthcare. Let me again go back to the charts here, and I want to show you HHL, which is the Harvest Healthcare Leaders Index Income Fund. So this is an actively managed strategy, and they use options for, so you can see here some of the holdings. They target a yield, I think, in the 8% range. Part of it comes off the dividends from the biotechs and not the biotechs, the pharma companies. And the other part, because the volatility in some of these biotechs is really high, they generate an awful lot of option premium coming off these options that they're writing. And there's almost 400 million in the strategy. And the indicated yield is a little over 9% right now. So that might be something that works for you here. When you look at the chart in terms of total return, and we look at it over a sort of a 5-year basis, and you compare it to the MSCI World Healthcare Total Return Index, had you just bought the index overall, you would have done better. So this is a way to get yield, get the exposure to the sector and some growth, but really it's more of a yield focus. Because when you look at it, you see the price change in the last 5 years is actually negative, and almost all of the, in fact, more than all of the return in the last 5 years has come from the yield component of the strategy. So if you want exposure to healthcare for the yield aspect of it, HHL it might be something for you to look at, Ron. Can I please recommend a couple of ETFs that play questions there, pay high dividends? So when you do covered calls, the tax treatment is capital gain on the covered calls. And so I like covered call strategies for that. BMO is the leader. So depending on where you want to play, BMO's got a whole suite of high dividend covered call ETFs. And I would go to the National Bank portal, go to the BMO website, look at screen for high dividends, ZWP International, ZWE, ZWH, US, ZWC Canadian, and so forth. And I think, Carlos, you'll be quite happy with some of those. What's the best ETF to short the NASDAQ or S&P if we believe? So I don't like to play the leverage ETFs. My favorite ways to play the short side is with a single short. So the ProShare short QQQ PSQ and SH for the single short ProShare S&P 500. And if you look at those relative to the QQQ and the SPY, what you're going to see is basically an identical one-to-one inverse relationship there. Let's look at it on a year-to-date basis, so it's easier to see there. Okay, so those are the ETFs you would use for that. So thank you, Sally, for that. And then okay, so that's the final question. Let me go to the online now. We've got another 15 minutes. Okay, so online questions. Any plans to offer an ETF version of the BMO Tactical Global Growth ETF Fund Advisor Series? So I would say if you want an ETF version, we actually have reserved the ticker ZZZG and ZZZD for the balance in the growth version. And BMO hasn't decided to launch those yet. They get reviewed every year for launch, and for whatever reason, they only launch a few at a time, and they've come up with some other choices. ZPay was one that I had asked for. We're working on some other ones. So it may come up in the next year or two, but you can buy the F-class version of the fund at the discount broker, and it's going to have the same MER as an ETF version. It can't be traded during the day, but really, folks, if you're buying my portfolios, it's not, you know, the idea is not to trade the trader, but if you want to do that, I understand. It's to buy the style of investing and trust that we're making the decisions for you in that. So thank you, Andre, for that question. Excellent charts. Well, you're welcome, Eileen. If Biden wins and the Democrats sweep both houses, there could be a huge stimulus package and maybe multiple packages until a vaccine is available and distributed. Despite the additional debt and increased tax on corporations, do you think this will support the economy and markets will go higher through? So David, I did comment on that, and it's a great question, and I think it's very possible. And for my strategies and for what we do for our clients, I'm very, very aware of that potential outcome. And we'll be positioning for that where we're still going to have some volatility protection on the downside for that eventuality, but we're going to leave the portfolios exposed to the upside as well, far more than we have. So I think that's a very real possibility of an outcome. And listen, again, I don't like it. I don't fundamentally think that it's a great idea. They have to print money to keep the economy going and the world going, but that is the world we live in. And so, yeah, that's a real possibility. What is the ETF that Larry's talking about now that it's around 45-ish? So if I would have to go back into the deck and kind of look at that. So let me see if I can kind of do that offline here without scrolling through everything here for everybody. Just bear with me 1 second, folks, as I look at that. My guess is that I was looking at the ZMT is probably that. It's not in the 45 range, it's in more of the 35, 36 range, but that is a global base metal ETF, if that's the one you're thinking about, Wendy. Michael asked, what is reflation? So deflation, disinflation, falling prices, you know, recession. Reflation is rising prices. And so it's the opposite, or if you think about a V, deflation, reflation. Hopefully that explains that. Kirk asks, thanks for the education. Are cars, ZGQ, and cyber expensive at the moment? So cars, if we look at cars as an ETF, so this is the Evolve ETF. And if we look at that, we can see that there it is. So, chart perspective, it's not early, it's not cheap. If we look at some of the details behind this, what do we see? So we see that the fundamentals here, if we look at the holdings first of all, not sure why it's showing a lot of cash in the portfolio, to be honest with you, but let's have a look through and say, okay, so the average price to book is 3, price to sales is 1.24, so that doesn't seem, there's no PE, which kind of tells me that there's not a lot of earnings behind a lot of these companies because there's no PE there. So let me just see if I can pull up the holdings here because it didn't give them to me in the traditional way that I would normally look at them. And I'm going to see if I can do a portfolio look through here on the Bloomberg. Oh, incidentally, folks, if you want a Bloomberg terminal, they're about $30,000 a year. Okay. Information technology. So on the technology side, you're owning a lot of these that are playing in the car space. I guess microchips that go in cars. Consumer discretionary names. So BMW's in there, Ferrari's in there. Kind of, interesting. Ballard Power, some of the battery players. I was expecting to see Tesla in here, and I don't know why I don't see Tesla. I would have thought Tesla would be in here for sure. And it's possible these holdings aren't up to date. So listen, it's not cheap. I think the automotive technology play is very real. But a stock like Tesla, we can take a quick look at Tesla. So it's in a consolidation pattern. Normally these flags are bullish patterns as long as the trend lines here on the bottom don't break. Fundamentally, I think Tesla is ridiculously overvalued, but they're in a great space. So the question is, what do you pay for it? And again, looking at some of the details here, I think a lot of these things become eye-opening. So in terms of revenue and earnings per share, right now, the company makes $20 billion in revenue on the sales of autos on a trailing basis, 30 billion this year, next year expected to be 43 billion. Let's do this and compare it with Volkswagen, which is the biggest car company in the world, that has 10 times the sales this year, and maybe 5 times in a few years. And what is that stock trading for when we look at the profile of the company and the PE? So this is trading at 15 times. Tesla, 900 times. So how many cars is Tesla delivering this year? 400,000 ballpark. It's got a market cap of 400 billion. Do the quick math there. It's trading for $1 million per delivery. I think that math is correct. Anyways, the point being, this is it's colossal. What does Volkswagen trade for? $8,000 per car per delivery. So the valuation is absolutely insane, but people who love it love it. So I love the cars trade. but I think it's expensive. Wrap Canadian ETF tax implications. Generally speaking, there's double taxation tomorrow. I'm not a tax expert and I wouldn't be asking me that question, but generally speaking, if you have an international stock and you're paying tax locally and it's wrapped in a US stock, there's double tax. I think that's what you're asking about. So there are better ways to invest, and ETF of ETFs are not the best way to play that, and because there's that extra level of tax. But again, I'm not a tax expert, and what I would ask that question is go to the issuer where you have the question and ask them, am I still recommending ZWU? And the answer is yes. For yield players, so if we look at, again, what's in it, you know, it's pretty stable. Yield, it's not without risk. Yield, close to 8%, but I think 6 to 7 is long-term stable for this. If you look at the underlying stocks are yielding 5, and the covered call overlays adding about 3. So that's where that's at. If you look at the holdings, you've got utilities in there, you've got the telcos, you've got traditional ones, you've got your pipelines and so forth. So that's what you're owning, and it's a nice yield play. And yes, I still like it. I like your favorite list. I have cash in my use account. Can you help me find equivalent ETFs in US dollars? So those are US dollar ones on my buy list, most of them. Nick? What about bank ETFs in Canada and the US? So I mentioned last week, if you weren't on last week's call, I've added to my dividend fund a couple, 1% or so, just a small amount, but we started nibbling on ZWK. Again, if you look at a way to play the banks with a covered call overlay, it dipped below 20. We were buying in here. Every time it dips a little bit, I'm going to buy it. I think we can pull off a yield sustainable in the 6% range in this basket. And that's the way I'm playing the US banks. I don't like the risk return in the Canadian banks right now. I'd avoid that. What time are we? We've got a couple minutes left. The one with all the engineering companies for infrastructure that was talked about, FLM. FLM. First Trust Global Engineering and Construction ETF. Again, very thin. There's not a lot of money in it. It's not great for traders, but I love the theme, and it's got a great basket of companies that will tend to do well. This is the infrastructure. You want the companies that are doing the engineering and the construction work, okay, globally, because we've got to put millions and millions of people back to work, and just about every government is going to be spending money to do that. Okay, where do we got now? My mother's 92 and risk averse, given that interest rates are so low. What's your thought on VRIF? Let me have a look at VRIF. I don't know what that is. So Vanguard Retirement Income Fund. Okay. It just came out, so obviously not a lot of history, not much I can tell. Do they have the holdings? There's no holdings, it looks like. No, so I'm not getting the holdings there. I can't tell you much about it because I can't look through it at the moment, so sorry about that. I will try to comment on that, Greg, once some details become available. Could you say a few words about ZPay and ZPayU? Yeah, Alex, my favorite ETF, again, big holding in my portfolio. Last week or 2 weeks ago, maybe it was the August webinar, BMO talked about what ZPay. So generally speaking, you're going to be long with a covered call on great stocks, generating yield. Target 6% plus the distribution. when you find a stock that we want to own, but not at the current level, you write a put to buy it 5, 10, 15, 20% lower, target a 6% yield. So it's got a sustainable yield of 6% or more, and it's on average going to have 50% exposure to equities, long covered call, 50% writing puts. Market goes down, you get put stocks, so you get longer. When it goes down, you buy low. Market rallies, things get called away. You have less exposure. When it goes up, you sell high. It's a buy low and sell high ETF that yields 6% and on average is going to have about half the risk of the US equity market. 2 thumbs up. Folks, that's it. We're out of time. Thank you so much for joining us this week. Really appreciate it. If you can support one of our charities, would be thrilled to match your donations. Look for that link in the email that's going to follow the seminar, probably coming out tomorrow. And if you want to make use of some of our companies, if you want opinion on your portfolio, reach out to us at etfcm.com, independent fee-based financial planning at UPotential. If you're a financial advisor, check out qwealth.com and see if that makes sense for you. Thanks, everybody. Have a great week. Stay safe, stay healthy. We'll see you next Thursday at 7 p.m.